After the 1970 recession, a group of about 50 large-cap stocks began to soar. They became known as the Nifty 50, widely seen as solid buy-and-hold-forever companies. Think Coca-Cola, Disney, and Procter & Gamble. The Nifty 50 led a massive market rally. By the end of 1972, the concentration of the top 10 stocks in the S&P reached a high of around 28%. But then came the big change. A deep recession came around in late 1973, and the market began a dizzying descent. These high-flying stocks with extreme valuations got crushed and went on to underperform the broader market for the next decade, clearing the way for new leaders to emerge. Fast forward to the late 1990s. Following the 1990 recession, a new group of tech darlings took over. Companies like Microsoft, Cisco, Intel, and Oracle were the must-own stocks of the new internet age. They massively outperformed, leading a huge market melt-up. By the peak in March 2000, market concentration was again at an extreme, with the top 10 companies reaching around 23% of the S&P by market cap. And once again, the pattern held. The bubble burst just as the economy was heading into the 2001 recession. The dot-com leaders collapsed, and many took over a decade to recover. This allowed a completely different set of companies to lead the market after the 2008 financial crisis. There seems to be a pattern. Historically, recessions have often acted as a reset button for market leadership, but that may be changing. Just look at today's market. The current leaders, Microsoft, Apple, Nvidia, Google, and others, have dominated for much longer than their predecessors. They've been on top since just after the great financial crisis, more than 15 years ago. Their outperformance has been relentless. There have been only a few notable blips: the 2020 pandemic recession, the 2022 bear market, and the 2025 tariff-induced market crash. None of these have shaken the market leaders from their position on top. Instead, they've just grown stronger with the rise of AI, which has only powered the ascent of megacaps even more, pushing concentration to new highs. So why hasn't this bubble burst like the others? One key argument is valuation. Just look at forward price-to-earnings ratios, which are based on analysts' expectations for future earnings. During a bubble, these expectations can become disconnected from reality. The tech sector in the early 2000s saw a massive spike in forward PE ratios, peaking above 50. Today, the forward PE ratio for the tech sector sits around 30. So while current valuations are certainly elevated compared to long-term averages and show an upward trend, they're not yet at the extreme levels seen in March 2000.